welcome back. Last leg of the show, we'll be talking to managements, and this time focus is on SKF India. We are joined by Mayank Kulani, who is the CFO. Mayank, hi, good morning, and welcome to the show. All right, so demergers, one-off were guided to normalize by end of current year. Can you quantify the remaining one-off drag in Q2 and Q3 and maybe give us a clean EBITDA number investors should track?
So, the EBITDA number for this quarter are clean. So, whatever demerger-related costs or effects were there, that were taken into account in the last financial year. So, what you see now is a clean number.
All right. Now OEM is, as of now, 51% of sales versus 46%. So that was a quarter ago. Is this mix shift structural, or do you expect distribution to bounce back marginally in H2 FY27?
See, normally what we expect the distribution business to be around 20-22% range. Maybe some quarter on quarter you may see a slight gap. Like if you see last 2 quarters of the last financial year, there was a jump in OE sales because of GST reforms, right? So which led to the increase in mix of OE. But largely we expect distribution business to be around 28%.
Let's talk about wind that grew almost 91% quarter on quarter in Q4 FY26. Now, how lumpy is the segment, and what's the sustainable quarterly run rate for wind going forward now?
So if you see this quarter, we are looking at for full year basis. If you see, we expect a double-digit sales growth in terms of close to 20% range or upwards of that. That's what we expect on the sales growth. And similarly on EBITDA, if you see, our expectation on the year-wise, if you see, will be around 17% range.
All right, Mr. Kulani, also Pune Greenfield is 2 years away. In the interim, what is the revenue ceiling given the current capacity, and how much demand are you leaving on the table?
See, Pune Greenfield plant is not for SKF India. So that is for SKF Industrial, which is the demerged entity, right? While we are focusing on Capex, we are doing Capex of which we announced last year about 500 crores Capex. Across our 3 facilities, Haridwar, Bengaluru and Pune. And we are focusing on increasing our capacity, and that will be completed by end of calendar year 2028, financial year 2028.
All right, localization is at 60%. Now, which product categories have the highest import dependency today, and what's the roadmap to get to 75% plus given the FX headwinds?
So see, we are already, if you look at our SKF India portfolio, our raw material or the materials component is close to, more than 80% localized, almost 80%. And in terms of finished goods, it's very less. The dependency on finished imported goods is very less. We are largely localized.
Okay, RPTs with the SKF group entities are a total of 4,900 crore rupees. How do you ensure arm's length pricing, and what is the risk if the parent changes transfer pricing terms?
See, the RPT, the large number of RPT, what you see today is primarily coming from the transactions with the demerged entity SKF Industrial. And this kind of structure will continue for a couple of years till FY28 when their new plant for the other entity comes up. And then it will obviously, because currently it's all in the same premises in Pune, their plant is also operating within the same premises. So that's where it is. And as far as the arm's length pricing is concerned, we are completely compliant with the guidelines, be it accounting guidelines or the tax guidelines, and follow exactly what is required to be done as per the rule. And our pricing is accordingly decided. And that same is reviewed by the auditors as well as the audit committee.
All right. What about a permanent appointment of the CFO? Is that being made? And how has the finance function been managed through the post-demerger integration?
Probably you missed the announcement. I joined as the permanent CFO in May. So which the announcement was made along with the financial results announcement for last quarter of the last financial year. So I joined in the mid of May last year. as CFO for SKF India.
All right. Thank you very much for joining us, Mr. Kulani, and answering all those questions.
Thank you.